Today I want to share with you a year-end tax planning strategy that utilizes a donor-advised fund. I just implemented this approach with one of my clients in a real-world case. The tax savings we estimated were going to be in excess of $15,000. So I wanted to share this concept with you today. That's what we're talking about. Let's get going. Now, I want to start by just touching on how donor-advised funds work, because if you don't understand this, the rest of the video, when we're talking the tax planning strategy, it's not going to make sense to you. So a donor-advised fund is really nothing more than a charitable account that you as an individual can establish to get not only a tax deduction, but to also set you up to do charitable giving, essentially for the rest of your life. So the beauty of these is you get an immediate tax deduction for any contributions you make. And again, then you have this pool of money out there which can be granted out to charities over many, many years, even decades. So for example, if I wanted to set up the Ted Erhart Charitable Fund here in 2024 and make a $50,000 contribution to get that going, I get an immediate tax deduction this year for $50,000. Okay, then I have this pool of money over here, which I can give to all my favorite charities. The beauty of this from a tax planning perspective is me, as the grantor to the account, can pick the number. So for example, if we're doing tax planning and we're trying to be strategic and stay under certain income thresholds, we can basically engineer deductions by saying, hey, okay, well, I need my income to be $25,000 lower, write a check to our donor advised fund, and boom, we have that tax deduction for the year. So they're a great tax planning tool, and I'm going to show you more when we get into the examples. Now, let's jump right into a hypothetical example. Even though this is hypothetical, I just want to mention that the numbers we're going to look at when I illustrate a tax return for you are very similar to the real-life case that I was working on in just the last couple of weeks. Now, that being said, let's take Mary, for example. We're going to say Mary is 65 years old. She's retired, and notably, she is not married. Okay, that is an important point, and I don't want to go too deep into this, but because Mary is not married, when she files her tax return, she's going to do so as a single filer. Okay, and that contrasts, of course, with married couples. Now, the one thing I want to mention here is this entire strategy we're going to be talking about today, it tends to work a little bit better. It's easier to make the numbers work with single filers, and it has to do with the way the laws are written presently around tax deductions, specifically the standard deduction and the limits on state and local taxes as it relates to deductions. So I don't want to go down that rabbit hole, but generally speaking, this works a little bit better for single folks. It depends on your circumstances, though, and it absolutely can be in play for married couples as well. Now, let's get back to Mary and take a look at her various sources of income for this tax year. So we're going to assume that she's got $30,000 of Social Security benefits. She's got a pension a little under $24,000, and she's taken $3,000 per month or $36,000 per year from her pre-tax IRA. But down here we have a question mark because Mary has a sizable, what we call non-retirement account. We also sometimes will call these non-qualified accounts. And the reason this is a question mark is because at the beginning of the tax year, we don't know how much capital gains this account's going to generate, how much dividends, how much interest, etc. Okay, so it's my job as her advisor to assess this close to the end of the year to see the significance of the taxable income being generated from this account and work with her to see if there's any offsetting actions we can take to minimize the tax bill. So that's what we're going to look at next. We're going to take a look at some tax returns. We're going to assume in this example that I've done some of that work. I've assessed this. I'm recording this in December. And we'll say, for instance, that I'm seeing about $30,000 of capital gains that are being generated from this particular account. So next, what we're going to do is we're going to look at a tax return. I'm going to model this out, what things look like with this baseline, and then how this additional $30,000 changes the numbers and what we can do about it. All right, I've modeled things out so we can take a look at how Mary's baseline income is going to be taxed without the capital gain. Then we'll add that in so we can see how the numbers change. So here's a hypothetical 2024 tax return for Mary, and if we pan down, we can see her various sources of income beginning on line 4. There's the IRA distributions for $36,000. Line 5's got the pension. Line 6 has the taxable Social Security benefits. Remember, even if her gross benefits are $30,000, a maximum of 85% of Social Security is taxable. So in that case, she's hitting that maximum for $25,500. So this gives her her total income of $84,800. She gets a standard deduction in this example, $16,550 for singles over age 65 in 2024. That brings her taxable income down to $68,250. Take note of this. We're going to reference back to that in a little bit. Bottom line is it means her tax bill for the year without the capital gain would be $10,074. Next, let's add that capital gain in and see how things change. All right, here's our adjusted 1040. Let's go down to the income section. We're going to go down to line 7. There's that $30,000 capital gain, so it's pushing her gross income up, and of course her net taxable income up now to $98,250. The tax bill for this new total is $14,574. So what that means is that capital gain is costing her $4,500. Okay. Now, the next thing I do when I'm thinking about tax planning strategy is I want to look at the marginal tax brackets to see how close she is to some of the key income thresholds. Is there a way that we can avoid getting hit in some of those higher brackets? That's what we'll take a look at next. Now, we're going to look at two separate sets of tax brackets because remember, Mary has multiple types of income. She's got ordinary income, which is being generated from the Social Security, the pension, and the IRA distributions. And then she's got that $30,000 long-term capital gain. And remember, that gets its own special tax treatment in the tax code. Now, we don't have time to get into how these two types of income interplay with one another. I did an entire video on that. I'll link it in the top right-hand corner up here. It's my most viewed video on YouTube because people have so many questions around it. So check that out if you want a deeper discussion about the different types of income and how they work together. But for now, let's get started. We'll take a look first at the rates for ordinary income. Now, if you look up at the screen, here are the tax brackets for ordinary income in 2024. Mary is, filing as an individual or a single filer, so she's going to be subject to these rate thresholds in the left-hand column here. Now remember, her taxable income, that net after deductions number, we're coming up with a figure of around $98,000. Now, she does have a mix of different types of income, but nonetheless, just to cut to the chase, she is going to be up here in this 22% federal bracket for at least some of her ordinary income. If we pan over to the capital gains tax brackets, again, the bottom line is based on her total income, her total taxable income, her capital gain would get hit in this middle threshold of 15%. Now, when I'm reviewing a situation like this, as someone who's, doing tax planning, I'm trying to game out scenarios where we can manage her income down to some of these key thresholds. If you take a look at, for instance, where the top of the 0% tax bracket is for long-term capital gains, it's about $47,000. And likewise, if we go back to the ordinary income rates, where does the 12% federal bracket cut off? It's about the same number. It's right around $47,000 before you get this huge jump, a 10 percentage point jump up to 22. So what I'm thinking about in a situation like this is, how can we engineer some deductions to bring Mary's income down potentially right to this rate threshold, which could really result in some material, in fact, some significant tax savings. Now, maybe you can see where things are going here. This is where that donor advised fund comes into play. Now, we're going to say in this example, like the real world case that I worked on in recent weeks where my client had a donor advised fund in place, we're going to also assume that Mary does as well. The bottom line is her taxable income on our base case is around $98,000, which includes that capital gain. We're trying to get her income down to $47,000, which means she needs a tax deduction in excess of $50,000. In fact, the way the math works out is she would need a $57,000 contribution to her donor advised fund to accomplish our objective of reaching that roughly $47,000 number for taxable income. And I'm not going to get into how that is calculated. It has to deal with kind of the quirky rules around deductions in the tax code, specifically as it relates to the standard deduction and the limits on state and local tax deductions and so forth. The bottom line is, you're going to have to trust me on this. She needs a $57,000 tax deduction. She can do that, or she can get there by making that contribution to her donor advised fund. So next, I want to just show you what that would look like on her tax return and the total tax savings which it would result in. All right, real briefly, let's just take a look at the tax return. Again, before we make this change with the donor advised fund contribution. Again, here's all the figures with the capital gain. Her taxable income is about $98,250 with a total tax bill of $14,574. Now let's just assume that I met with Mary and gave her my recommendation to make a $57,000 contribution to her donor advised fund. Let's take a look at how that would change the numbers. All right, so here is our final tax return. Let's see how the numbers have changed. If we go down, we can see all the income numbers are the same. Our gross income number still $114,800. But here's the big change on line 12. Our deductions are now $67,000. And if you're saying, hey, wait a second, I thought you said $57,000 was going to the donor advised fund. And that's right. But what's also included in here is $10,000 for state and local income tax. Okay, that's the maximum deduction you can take. And I'm including that in this example because virtually every tax return I assess, people are able to hit that cap. So we're also including that in the example here. But the most important thing when we get down to line 15, the taxable income number, we're hitting our target. Remember, Mary was at $98,000 and our goal was to get in the ballpark of $47,000, and that's exactly where we landed. And take a look at the impact. She went from a tax bill of in excess of $14,500 to now around $2,000. So the result here is, the bottom line is, we're cutting her tax bill by $12,500. Now, you might be saying, yeah, Mary saved $12,500 of income tax, but she had to dump $57,000 into a charitable fund. Well, that's true. So obviously, this strategy is only going to work for people who are charitably inclined. But a lot of the clients that I work with are. Many people make thousands of dollars of charitable contributions every single year. And the beautiful thing about a donor advised fund is you can make a lump sum contribution, again, get the tax return in a given tax year, which can be so beneficial for planning purposes if you're trying to hit certain income thresholds, and then you have the rest of your life to give that money away to, whatever charitable organization you see fit. So these donor advised funds can be great tax planning tools. That's why I wanted to illustrate this for you today. I hope it was helpful. If you got any question, please drop those down in the comments section. And as always, I hope we'll see you in the next one.